Good morning and welcome to the autumn Vickery Holman Market Review update. I'm delighted that so many of you have been able to join us here this morning. We will be recording the event as well for those who aren't able to join us live, and we'll make available the contact details for that. My name is Mark Pello, Managing Director at Vickery Holman, and to say this is the third of these events that we've had in this format, or post-COVID, compared to the live events we used to do from each of our four offices in Truro, Plymouth, Exeter and Bristol. But this way we believe we can give a regular update to all our clients and people who want to work with us on a 6-monthly basis, seeing what's happened both in the past 6 months, but also going forward, what we think is likely to happen. So the plan will be to do a spring 2022 update as well. We have some other events also, which I'd like to provide a few details about. You will see details on the screen, webinars on At Leisure on November the 16th and Development on December the 1st. So those are events which we'll provide links to later on. So thank you. In terms of today's event, it is a 1-hour format with 6 speakers on doing 6 presentations from representatives from across all 4 of our offices. There's an opportunity for polls to be completed on each, and questions and answers in the chat program. After we have done the formal presentations, Alan Trelaw, Director in charge of agency, will do a question and answer session and reflect on the polls results in that. So hopefully we'll pick up a number of your questions at the end. So please do participate. So you don't need to hear from me for too long. I'm going to now hand over for the first of our speakers. It will be Will Oldreeve, based at agency Truro office, who's going to talk about the office market. So over to you, Will. Thank you.
Thank you, Mark. Hello, my name is Will Oldreeve, Senior Surveyor in our Truro office. I'm going to give you a brief overview of the office market across the southwest. The good news is that in most locations, office demand has come back. We have had a very tough 18 months in this sector as the country was told to stay at home to work during lockdowns. This has had significant impact on demand for offices as businesses effectively press pause on any decision to move or lease an office for the first time. We did expect a wave of assignments and sublets opportunities to hit the market in a rush to reduce costs. However, this did not happen. Now we're seeing good demand for offices as there is more certainty about the ability to use the space, and it is clear that businesses always had faith that an office would be required for their operation, even if that is more of a flexible working environment. It will be interesting to see the results of the poll for this section, and I do not want to give away any plot spoilers, but we are seeing the majority of companies adopting a flexible part-time working pattern with a mix of office and home work. In the long run, I think this will mean companies will need less space as hot desking becomes part of the norm and storage less of a requirement as this migrates online. The only exception to this demand is in Exeter, where we are not seeing it increasing as much as we have done in Plymouth and Cornwall. It will be interesting to see if this demand continues. I suspect the current level is somewhat of a backlog from the past 18 months, and that we will see it stabilise as the backlog is worked through. There has been a trend of businesses relocating to the southwest as people move out of the cities during the lockdowns, and the business followed as directors would rather have an office close to where they live. Also, the southwest is an attractive destination to base a business due to the affordable occupation costs, lifestyle opportunities and good transport links to the capital. I believe this trend will continue in the foreseeable future. So moving on to supply. Supply has remained relatively low in contrast to what we had predicted, as I mentioned earlier, with assignments and sublets. In Exeter, the main supply is out of town, with very few opportunities becoming available in Southernhay and other town centre locations. There is a similar story in Plymouth, and in Cornwall, supply is spread across the county in places like Camborne, Newquay and Hale, rather than just being Truro focused. Throughout this period, there has not been much fluctuation in rents. In Exeter, Grade B, C offices are in the region of £15 to £16 per square foot, and Grade A in the mid-20s. In Plymouth, Grade A is £14 to £15 per square foot, and Grade B, C around 10 to 12. In Cornwall, it's similar to Plymouth, with top quality offices being in the region of £14 to £15, and poorer quality grade B, C between 8 and 10. In Exeter, there have not been many significant lettings due to the subdued market. However, there are a few new schemes coming to the market, including Broadwalk House in Sunhay, One Manor Court, and Exeter Science Park continues to expand with the Ada Lovelace building. In Plymouth, we have recently completed a letting of a ground floor unit at Plym House in Marsh Mills, achieving a rent of £12.50 per square foot. Interest levels were high and we had 3 offers in the end to lease the office. Other significant schemes include the Merchant and offices at the Royal William Yard, where lettings have transacted since the lockdown. In Cornwall, the enterprise space for advanced manufacturing, which comprised 6,700 square foot of brand new office accommodation on the outskirts of St Austell, is now fully let, with rents achieved of £12 per square foot plus a service charge. The offices at Sector 2 on the Aerohub Business Park in Newquay are also now fully let or under offer. This scheme comprised 8,500 square foot and rents have been achieved of £12.50 per square foot plus service charge. In terms of new schemes coming to the market, Vickery Holman are currently letting 13,250 square feet of brand new Grade A office accommodation at Chide-Hevians in Poole. Thank you very much for listening today, and I'll now pass you back to Mark, who's going to introduce the next speaker.
Thank you, Will, and for that talk on office market, what interesting that's going to be over the next few years. And certainly if we're going to see headline rents, as quoted there for Exeter, for instance, it just shows the cost of building to make a viable product. It needs to be quite a lot higher than what we've achieved in the past. But thank you for that, Will. Now I'd like to hand over to Joe High, Head of Agency in Plymouth office, who's going to talk about the retail market. Over to you, Joe.
Thanks, Mark, and good morning, everyone. For those of you who don't know me, I'm Joanne High, and I head up the commercial agency team at Vickery Holman. I'm covering the retail sector across our region today. Looking back, because this year seems to have flown by, our last market update was at the end of March when we were still in lockdown. A lot has changed since then. At the time, we were predicting what would happen to demand when the shops were finally allowed to reopen, but that didn't happen until the 12th of April. Before that, we saw restaurants and pubs opening with people eating outside in their duvet coats with their hot water bottles. If you cast your mind back to the shops reopening, we saw massive queues outside the likes of Primark, to name one, but also other retailers as well as barbers, because you can't get a haircut online, proving that there was pent-up demand from consumers wanting to spend the money they'd saved during the lockdowns. The traffic light system made going abroad very difficult, and therefore as summer approached, most took the view that a staycation was the safest option. I won't say too much about this, as Mike will be giving us an update on that sector shortly, but if you did manage a staycation, then well done for getting through what felt like the Hunger Games to make a booking. What it meant for the retail sector in the southwest was an even higher demand as holidaymakers flocked to our coastal and market towns keen to spend their money. The smaller retail units are still in high demand. If the rateable value is below 12,000, meaning they qualify for small business rates relief, then they are snapped up by tenants. We've had a number of instances where we've had multiple offers for these small units. Take this shop at the Crescent in Exeter. The asking rent is £18,000 per annum, and we've had over 10 offers for the property. Rishi announced in his budget last week that retail, hospitality and leisure properties would get a 50% discount on their rates for the forthcoming financial year, which is great news. This property in Plymouth was previously a co-op, and there was little interest in the whole unit, so the landlord is splitting it into 3 smaller shops. One is under offer, and we've had a number of offers for the remaining 2, and the works haven't even commenced yet. These units tend to be in local centres and on neighbourhood parades. As people are working from home a lot now, these local centres and neighbourhood parades have seen increased demand, as consumers want to be able to source their goods and services locally. Due to this trend, we've seen an uplift in rents compared to pre-COVID levels. Also, requirements for drive-throughs have increased as people want that convenience nearby. Turning to prime city centre units that have been hit really hard, we've seen the Nationals circulating requirements again. There haven't been a huge number of transactions yet, but those that have happened have been very soft deals, with landlords having to offer meaty incentive packages, including rent freeze and capital contributions. In London and the North, we've heard of capital contributions being £500,000 to £1 million, whereas in the South West, we haven't heard landlords having to agree anywhere near £500,000, showing the resilience of our region. In Plymouth, we've seen Tommy Hilfiger, Tag Heuer and Breitling move into Drake Circus, and Ted Baker have moved into Princess Hay in Exeter. We've seen a slight bounce back on rents for city centre locations, but this is compared to the steep decline during COVID. It still means city centre rents are half what they were pre-COVID. Take this letting of the former Thorntons on Pydar Street in Truro, which was let to Grapevine for £35,000 per annum. This unit in Sidmouth had offers from national companies whilst being marketed as one unit. We also received interest from independent retailers who wanted only half of the space. The landlord decided to split the unit and take the independent retailers because they believe that there is more security and less risk from an independent. An interesting and very valid thought, given it's an independent business's livelihood, whereas for a national it's much less personal. We've been marketing the former Debenhams building in Plymouth. We've had a great response and the unit is now under offer for in excess of the asking price. We've had a wide variety of end users interested, from leisure, retail, residential, entertainment, conferencing and training, to name some sectors. What has been particularly encouraging is the wide variety of uses and ones that you would never have considered for the property, which is really exciting for Plymouth. This shows the trend for innovation and repurposing across the retail sector. Take IKEA, whose parent company, Inca, have just opened an IKEA anchored scheme in China. It's 1.4 million square foot, has 380 stores, 500 flats and co-working spaces, which have been designed and furnished in collaboration with IKEA to appeal to residents working from home. Another great example is John Lewis, who have launched a rental service for furniture. You can pick anything from their range and swap items as you wish, or buy them out and you won't pay more than the retail value. It's a really innovative idea and great from a sustainability point of view. Sustainability is thankfully much higher on people's agenda now, and with these big firms making positive movements, it will filter down through the sector. And it will have to, because that's what consumers now want, and they are much more educated on waste and what it takes to make an item than ever before. Finally, the restaurant sector, which took a hammering during COVID, has bounced back. We're marketing the former Las Iguanas in Exeter, and we've had a number of offers from various different restaurant concepts. The unit is now under offer. It's 3,000 square foot on ground floor, which is the optimum size for restaurant operators. There is also a flat and various offices on the upper floors. The asking rent was £115,000 per annum, and the deal was agreed during lockdown. We've just put Paternoster House in Exeter on the market. The ground floor is 2,500 square foot, and the basement is 3,758 square foot. We're quoting £25 for the ground floor, and we've already had offers close to that level. And for the basement, we're quoting £15, and again, we've had offers close to that level. So thank you for listening, and I will now hand you back to Mark.
Thank you, Joe. I think actually I've been told that the Las Iguanas one, there was a little extra demise included, so that the rent was actually achieved by us was well in excess of that in the end. So fingers crossed on that. But thank you very much. Also very interesting to pick up on some of the comments about landlords preferring independence sometimes to what would have been a former preferred national covenant. But that's the retail sector for you. Anyhow, now handing over now to Zach Maiden, head of agency here in Exeter office, who's going to talk about the industrial market. Over to you, Zach.
Thank you, Mark. My name is Zach Maiden, and I shall be discussing the industrial market in the West Country. It is no secret that the region's industrial market has performed extremely well over the past 18 months, with demand far outstripping supply. Over what would be deemed a very volatile time for all global business, the industrial market has seemed to buck the trend, with huge demand from large and small occupiers in all sectors, i.e. general industrial, trade and logistics. It is well documented that e-commerce occupiers have dominated the big box market, but what about the majority of the West Country's industrial supply? It's not all about logistics. So demand. Demand has been driven from a lack of good quality industrial accommodation in the region and an overspill from Bristol's booming industrial and logistics market. That and the influx of new business to the area and a strong residential market has added to the already heated industrial sector. It's also worth considering the rise of startups and small businesses who don't need a shop window for visibility. These small businesses still require business space, and with 100% rates relief, small industrial has proven more affordable than retail space. Next, we have the labour trade. Companies such as Babcock in Plymouth have invested heavily in an apprenticeship scheme to ensure skilled workers are nurtured and precisely moulded into their trade to avoid labour shortages in the future through economic forces, a trend that we expect will increase while businesses invest in their workforce. Over the past year, we have also seen a boom in the residential market as residents move out of London and into the West Country. House building and renovation supplies have seen a huge spike, and costs have therefore increased. Trade. As demand for home improvements and small business-to-business trade has increased, this has led to an expansion of trade occupiers to take more prominent locations, be it tool hire, plant, machinery, DIY equipment, plumbing, etc. Rents have drastically increased, and current supply cannot keep up with the trend. So the trends. There is simply a lack of industrial space. Our region has seen a lack of industrial development over the major hubs in the West Country. Naturally, there has been a number of high-profile sites, which I will discuss, but when you look at Marsh Barton in Exeter, Faraday Business Park in Plymouth, or Holmbridge Industrial Estate in St Austell, much industrial space is deemed dated and basic in specification. An issue that needs to be addressed when we consider the drastic nature of MEES in the coming years, almost certainly a topic to be discussed in a separate seminar. In fact, our Plymouth office are currently marketing 69 Faraday Business Park. Although booming demand, the EPC is borderline E, and the estate will require further investment in the future. Additionally, we're experiencing high demand from owner-occupiers looking to invest in their own businesses. Demand has typically come from small businesses looking to buy approximately 1,000 square foot at locations such as Bownton's Sky Park Business Park on the outskirts of Exeter and Mercury Business Park near Columpton. Plymouth and Cornwall are experiencing a similar issue with severe lack of stock of any size, and we predict rents to increase again as supply increases. In fact, when Tamar Caravan Centre on Valley Road, Plymouth became available, there were numerous offers for the 25,000 square foot unit. Such was the appetite for anything freehold that became available. Additionally, it is worth mentioning the proposed Blue Abyss, the deepest pool in the world, to be built at Aero Hub near Newquay, which will raise global awareness for technology and development in Cornwall. Large schemes in our region. As we have discussed the limited supply, we shall take a quick look at a number of development sites that aim to cater to the demand over the coming years. Exeter Logistics Park, currently home to Amazon of 90,000 square foot and DHL 55,000 square foot. Phase 2 has outlined planning consent for over 1 million square foot of B8 logistics space, over 72 acres of development land. This development scheme has a BREEAM of very good. Langage Energy Park. Langage Energy Park is a proposal to build upwards of 1,000 square foot units in the first phase and should be ready by the end of 2022 to the start of 2023. It is an energy park with focus on electric car charging, solar power and supply of electricity up to 20 MW. Aero Hub Newquay. This is to be the home of the Blue Abyss, deepest pool in the world. There's 15 service commercial development plots for sale. There's planning freedom and it's very close to the A30 in Newquay. The Air Park Exeter. It's a new commercial development site on the edge of Exeter Airport, and it's well located to cater for continuing demand in the area. Last but not least, MEES. EPC regulations are now starting to bite, and with all commercial lettings required to be at level B and above by 2030, there is concern that much of our current supply may never reach this level without heavy investment in the buildings or total redevelopment. The topic itself is worth discussing in further detail, but the impact it will have on industrial premises cannot be underestimated. A factor landlords are going to have to consider over the ownership of all their commercial investments and in particular industrial premises. This has been a quick snapshot of the industrial market, and I look forward to answering any further questions in the Q&As later. I shall now hand you back over to Mark.
Thank you very much, Zach. The industrial market has certainly been a consistent growth for the last few years, for sure, and probably the most consistent sector for all of us. Also interested about the EPC and how that's going to work out in the next few years. We know the level of stock we have. It does need action. So I will then pass on to the next subject, which will be Claire Cochrane, Head of investment agency, who's going to talk about the investment market, not surprisingly. Over to you, Claire.
Thanks, Mark. As mentioned, I'm going to give a brief run-through of the Southwest investment markets. Throughout the year, a better public health outlook, the final easing of COVID-19 restrictions, and the extension of fiscal support has helped underpin a more rapid economic recovery than was originally projected. GDP has bounced back considerably from a 300-year low to being just 0.8% below pre-pandemic levels in August, based on ONS statistics. Unemployment at 4.5%, with the Southwest recording the lowest national average from June to August at 3.4%. There are, however, some interesting challenges as we head into 22. Figures are yet to reflect the withdrawal of the furlough scheme. Job vacancy rates have hit exceedingly high levels, resulting in labour shortages. Global supply chain issues have coincided with high demand, and an energy crisis is potentially looming. The rise of the national living wage, detailed in the autumn budget, will also increase costs, and inflation remains above the Bank of England target of 2%, causing speculation that interest rates will rise before the end of the year. So how have the commercial investment markets fared amid all of this? Well, I'm pleased to say that the better than anticipated projections have increased confidence and reignited both seller and buyer activity, resulting in projections for the year-end national transaction volumes to exceed 2020 levels. Demand remains significant as institutional investors, regional propcos, and SIPP investors all actively seek out opportunities. Administration changes have, however, slowed some local authority acquisition drives. Supply remains limited across most sectors, with wide discrepancy in the performance of subsectors and locations apparent. Industrial. The soaring occupational demand you've heard about against a restricted supply has helped maintain very high occupancy rates and fueled rental heights, making this sector top of many investors' shopping lists. Distribution and multi-let estates remain highly sought after, resulting in significant competition for quality lots. In the Southwest, we've seen a continuation of estates sold as part of large national portfolios, often stacked up by funds keen to gain additional exposure to this thriving sector. Likewise, lots that are offered in auction houses have often sold prior to going to the room. Yields, therefore, have hardened in some locations with no change in others, now typically 5.5% to 6% with what we would call Southwest Prime. If conventional prime assets were available, they would probably achieve better than this, as does stock in Bristol, which remains a different kettle of fish. Moving on to retail. As this sector emerges to a post-COVID era, a realignment in structure, rents and values continues. Clawing back trade from the soaring online shopping remains a challenge for the high streets, and many continue to work a split week between home and the office. Voids, rental changes and risk perception have adversely affected yields, but opportunities for repurposing to urban logistics and storage and residential, as we've heard, do add scope for a new type of investor to enter this sector. And indeed, some subsectors have benefited from the change in working patterns. Pockets of activity have been in coastal towns where occupational demand remains strong and attracted better yields. Likewise, neighbourhood parades benefiting from an increased spend from people continuing to work from home for part of their week are on investors' radars. Drive-throughs, pet stores and convenience stores remain popular. Yield-wise, there remains a wider discrepancy across the sector than in others. You've got some subsectors like drive-throughs, which are deemed more COVID safe, which attract a premium. One, a Costa Coffee, currently under offer in Gloucester, offer quoting rent of 5% net initial yield. Prime street yields, though, are now slightly worse, 6.75 to 8%, and rising rapidly towards double figures for some assets. An example of which is this property on 4 Street, St Austell, let to the South West Clark's franchisee, and under offer of an asking of 9.77% net initial yield. And moving on to the office sector, where activity remains muted, and the limited transactions do make it harder than normal to pinpoint any specific changes in yields, which, depending on where you are in the region, for prime are typically 6.2% plus, except Bristol, which again tracks a premium with lower yields and reflects the better quality stock available. We have started to see some more stock being offered to the market, such as Stirling Court and Exeter, with an asking price of 7% net initial yield. We do expect renewed interest in the office sector as it becomes clearer that companies will reoccupy. And opportunities could be created as they right-size for their new working norm over the next couple of years. A trend that continues is that ESG, environmental, social and governance, and healthy building credentials become increasingly more important to investors, as do EPCs across all of the investment market. That concludes what I have to say in the Southwest summary, but I think you'll hopefully pick up that the Southwest remains thankfully very resilient, but we are seeing wide discrepancies across the region remain. As ever, we're always happy to discuss any specific opportunities with you. Thank you for listening.
Thank you, Claire, and certainly variation by sector, and in the case of retail within that sector is something which we probably never had quite so many extremes of at the same time. But handing over next to our fifth speaker, Mike Easton, Head of Hotels and Hospitality here at Vickery Holman, and I'll let him tell you what he's going to happening in that sector. Thank you.
Thank you, Mark, and good morning, everybody. My name is Michael Easton, and I look after the hotels and hospitality agency business across the region for the firm. This morning, I'd like to review the last 6 months in the leisure sector across the region and reflect on its outcomes and what we anticipate will happen in the market over the next year. My question to the audience is the same as the one asked in our spring review, but given that holidays are a clear barometer of customer satisfaction, it is interesting to know what people are thinking this time around. First, to look at the operational market and the experiences for business owners, staff and customers. I think it's fair to say that the landscape is full of paradox, where on the one hand, given the severe economic realities of a global pandemic, and at a time where long-term job security is at its lowest, the market has bounced back in force, and the live for the day attitude is no better witnessed than with their overriding desire to eat, drink and be merry, and to set aside any long-term saving plan. For the Southwest, this has a significant impact, as whilst demand for accommodation reaches new heights, and with it the knock-on effect for food and drink, it brought about new pressures, as on the on-the-ground reality has been staffing and supply issues, and owners running their businesses under greater demands and continuing restrictions. Key to this was staffing. With firstly the loss of staff in the industry and a highlight on the unsociable hours and the rates of pay in comparison with other sectors, but also the newly coined pandemic, which resulted in many venues having to close at short notice, and a knock-on effect to customers booking more than one venue and a rise in late cancellations and no-shows. As with all things, this will need to change, and already we're aware of many operators looking to improve staff terms and conditions, and a growth in the deposits for table bookings becoming the norm. In short, attracting customers to all that the Southwest offers was not an issue, more how to cope with the demand, keep both the staff and the customers happy, and to make the best for the year after so much uncertainty and as government assistance was being removed. Once again, the sector showed great resolve, and for most in the region, this has been a strong trading period, and for many the season has extended into this month, which will certainly help for the winter ahead. So what of the impact on the commercial market itself? Well, the market for holiday parks, pubs, restaurants and hotels. As for the operational market, it did the opposite of expectations, and the rise in demand for venues is nothing short of extraordinary, as new entrants entered and demand far outstripped supply. This demand predominantly came from the sub £500,000 private purchase market, with new entrants to the trade looking for a change in direction and using equity from the bounce in the residential market, as the liquidity from the lenders remains hard to source. It came also from the corporate market, particularly for holiday parks, and a clear message that many felt the accommodation providers would be a safe bet for many years to come. Pictured are a number of groups that have bought or are in growth this year and in the southwest, and it's been supported in no small part from the lack of new stock to the market, as supports initially kept operators afloat, and the 2021 season was a time to open and to make money, not sell. Statistics from online property sites show that as much as a 30% decline in available stock year on year in some southwest postcodes. The result on pricing was, in the main, to keep values steady, with the exception of the holiday park market, where longer term strategies led to a higher ticket prices being achieved. As we look at the market today, we could consider it the best selling conditions since prior to the banking collapse way back in September 2008, although a note of caution, as there has been less activity in the mid-market, £500,000 to £2 million, as most are too big for the little guys and some are just too small for the big guys. Vickery Holman has handled a number of high-profile sales during the last period, to include the sale of Langdon Court Hotel near Plymouth, which will reopen next year as a world-class accommodation venue once renovation works are completed. We also dealt with the sale of Treorchy Barton in North Cornwall, which included a farmhouse, 10 letting cottages and 36 acres. We dealt with a number of pub sites, including a notable gastro, food and accommodation venue in the Cotswolds in an off-market transaction. Our business rates colleagues have also been very busy with a number of notable savings made for clients. As we turn our attention to the year ahead, we see the usual drop in trading for the winter, but an earlier bounce back into 2022 as consumer demand does remain high. This is even despite the results of last week's budget and the knock-on effect on pricing. But in order to keep venues profitable, there are other savings to be made. This is particularly notable in the pub and the restaurant sector, where there is assistance ongoing for rateable value. For the market, we're seeing more stock come available as clients look to cash out off the back of a successful trading period and to take a well-earned rate break. We do not anticipate any significant movement in pricing over the next 12 months, just a general freeing up of available stock. There is still a very strong demand for hospitality sites across the region, and whilst the next bump in the road is expected to be winter 2022, the medium-term view is that good operators have enough checks and balances to keep customers happy and coming back. And with that, I'll hand you over to Mark. Thank you.
Thank you, Mike, and a pretty positive message there, I think, of most sectors. Now I'd like to hand over to our final presenter today, which is Tim West, Development Surveyor Specialist. Over to you, Tim, about the development market.
Good morning, my name is Tim West, and I cover the Development East team for Vickery Holman, split between the Bristol and Exeter offices. So today I'm going to provide a brief review of the housing and development land market, followed by an emerging hot topic for the development industry, biodiversity net gain. Okay, so kicking off the housing market, recent data according to the UK House Price Index from the ONS states that average UK house prices actually went into reverse in July this year after hitting record highs a month earlier. We understand that the average price of UK properties stood at £265,000 in June, falling to £256,000 in July. It may be no coincidence that July's house price fall coincided with the start of a tapering to the UK government's stamp duty holiday incentive. However, despite the month-on-month decline, the ONS has stated that average prices in July are actually up overall by around 8% or £19,000 compared with the year earlier, so still very positive growth. The sentiment from the estate agents I've been speaking to recently across the southwest remains extremely positive going forward. The impacted demand of the withdrawal of stamp duty incentives is being offset by the continuing shortage of supply of homes coming to the market, and agents are still seeing extremely high numbers of applicants for each property coming forward. This is also reflected by the data released by property portal Rightmove, who've stated that the national average asking price of newly marketed properties rose in September to an all-time high of £338,000. Buyer behaviour is still reflecting the impacts of the pandemic as the race for space continues. This is being aided by significant amounts of companies resolving to allowing more flexible working arrangements and minimal office time going forward. Therefore, buyers from across the country are still being attracted to the southwest for its natural environment, value for money and quality of life. If there is indeed a small pause after the stamp duty holiday ends, it's expected that the housing market in the southwest will continue to flourish and price rises are expected to continue in the region, with large family homes in non-urban areas being identified as the most in demand in the current market. Moving on to the development market. The last year has seen the value of residential development land in the UK continue to show extremely positive growth, principally due to the previously mentioned strength of the housing market, coupled with strong demand for land and a shortage of immediate sites coming forward. Despite being supported by the strong performance of the housing market, there are clear challenges for the development industry going forward. An under-pressure planning system is constricting the supply of ready-to-go sites. Another key talking point, rising construction costs and uncertainty surrounding the labour supply are affecting investor appetite. The sentiment off the back of this is to move quickly. Any delays increase the potential exposure to much higher construction costs than originally planned for, as higher inflation becomes the new norm. In terms of delivery, just over 150,000 new market homes were completed across the year ending June 2021. This marked the highest annual total since 2007, and data from the ONS shows that the first 6 months of this year have seen a delivery of around 72,000 new homes, which is also the highest rate seen since 2007. It'll be interesting to see how the challenges facing the industry affect these numbers going forward. Right, now our hot topic. So one hot topic for the development industry are the proposed biodiversity net gain regulations contained in the Environment Bill, which is currently making its way through Parliament. One of the aims of the bill is for all new development to result in an increase in biodiversity. Once the Environment Bill becomes an Act of Parliament, which is expected later this year, and a transition period of 2 years has passed, it will be mandatory for all developments in England to replace any biodiversity lost through a development and add 10% to provide the net gain. Where possible, developers are being encouraged to provide the increase in biodiversity on the site itself. However, where this is not possible, developers must provide the enhancements off-site or purchase biodiversity credits. So mechanisms for providing enhanced biodiversity units would include on-site provisions such as meadows, ponds and public open space, off-site provision by creating and managing habitats on additional land, or by purchasing biodiversity credits which are then used to fund off-site habitat enhancements. It's important to note that the value of off-site provision will be measured directly by the proximity of delivery to the original development site itself to encourage improvements to the immediate area of each scheme being affected. Initial research around the impact of these new regulations is slightly alarming and suggests that the provision of on-site measures is likely to restrict the developable area of most sites by around 20%. In 2023, biodiversity net gain is expected to become a mandatory requirement for all developments in England. Some local authorities already have their own policies in place, and those buying land and gaining planning consent for development will need to factor in how they're going to deliver the biodiversity enhancements and the costs involved. Okay, well, thank you very much for listening, and I look forward to any questions.
Thank you, Tim, and I can see why it's a hot topic. So there may well be some questions to follow, I'm sure. Look, thank you all those who've put some questions and answers in the chat and also completed the polls. I am now going to hand over to Alan Trelaw, who I mentioned earlier is going to sort of chair this bit and bring in the presenters to answer as many questions as we can. So Alan, if you wish to join me, I will say my exits. Thank you, Alan, and leave you in his hands.
Thanks very much indeed, Mark, and good morning, everybody. Thanks for attending. As Mark said a bit earlier, I'm Alan Trelaw, and I head up everything agency at Vickery Holman. Been a director here for many years, and I'm very pleased to be in front of you today. Thanks all for attending online, so at least we haven't dragged you all over the country to attend a very large gathering somewhere instead. So hopefully we're doing a little bit for the environment today by doing this by the magic of the internet. There are one or two questions cropping up here, I think. around EPCs in particular, which we'll pick up shortly. But I would just like to whiz back over the polls a second, just because I'm sure there's some quite interesting things to pull out of that, and we do appreciate you putting in your answers. The first one, going back to Will's talk at the beginning, was about the office sector, and Will's popping back on the stage, I think, as well, just to add a little more flavour to this. But, hi there, Will. Thank you. And you can see the the mix of responses, which I guess bears out what most of us are familiar with nowadays. That the days of everybody coming in the office every single day of the week is rather different now, and the 43% of sometimes is probably is the norm. But it does mean, as you said, that there is still a need for an office space.
Yeah, I think that the interesting thing on the poll, I thought, was that if you look at the top two, which is kind of every day and most days as well, that kind of makes up quite a big portion, which I think ties in with what I was saying about there being business confidence and not being as much supply as we thought, and sublets and assignments, that businesses clearly, although it is obviously going to be going towards a more flexible working, clearly, strongly see a space for an office and a place to work and the benefits that has. So I thought that was quite interesting as well on the polls. Because
we found, our experience has been that office lettings have picked back up again, mainly, I suppose, of smaller stock, but not so the sort of the micro sort of size hot desking and stuff has probably disappeared for a bit, because it's a difficult thing to work with that, around COVID and so on. But anything with its own front door seems to, even the smallest of units seems to be letting, or seems to have let over the last few months. Anyway.
Yeah, and as I said in the presentation, I think that's definitely reflective of a sort of surge of demand coming forward as people have the confidence to think, right, let's get on and do what we're going to do, because we've been sort of procrastinating for a certain amount of time. So I think it's literally across from the tiny kind of co-working space, because people are sort of bored of sitting at home and want to go and speak someone up to the bigger stuff, and whether that's companies that are expanding or even downsizing, maybe there's still going to be activity there. Much larger companies might be downsizing, but that's still quite a big letting and quite a big deal potentially.
So there's still life in the office market, I think, is what we're saying. It's just changed a little bit, possibly, but it's still absolutely right there in front of occupiers' minds as being something they're not giving up, are they? So
absolutely. Yeah,
good. Thanks, Will. Thanks. I'll turn on to the retail poll a minute that Jo had up during the course of her chat a bit earlier, and Jo might like to come on and be around at the same time as well. And again, I suppose when the poll eventually sort of settled down, perhaps not surprisingly, a lot of people were have said that they shop their preference is a mix of both, 61%, the mostly online 31%. That's kind of would have been nice to perhaps see that and the mostly in person maybe equal each other out a little bit, but from what we've discussed in the past and probably presented about in the past, people, even if they end up shopping online, I think retailers are getting more, well, they've been savvy for a few years to this, haven't they? That there's a need for a showroom, even if your purchase is right there.
Yeah, definitely. I think you're right. I was expecting the mostly online to be a little bit less than it was, but still a mix of both is a good level at 61%. But I think that the lettings in Plymouth to the watch companies, that kind of backs up this whole experience thing. If you are buying something like that, you want an experience, so you're going to need a showroom. So that is driving some of the requirements out there. Definitely.
And a couple of other things you came up with, I think, in what you were saying, Jo, was partly this sort of the thing we've known before, the demand for coastal and market towns and so on, which we know very well, I think, down here, but and the interest in smaller units and people looking to avoid business rates if they can by taking smaller premises and that sort of thing. I think we perhaps know it was. What was interesting has probably been a development over this last few months, because you've seen it happen in the flesh, is just I think we even questioned at our last chat like this that we're wondering what people are going to do with the larger retail premises which are coming up in some of our town centres with some of these big department stores and that sort of stuff. You've obviously had the proof of the pudding with the interest you had in the Debenhams in Plymouth over the last few months. But, well, I think you used the words of pleasantly surprised. Pleasantly surprised, but we're pleased with the amount of interest and the diverse range of different uses.
Yeah, massive diverse. I mean, I didn't go into it in lots of detail, but massive diverse range of all sorts of. I mean, I think we all know the kind of go-karting rinks in Debenhams. We've kind of seen that elsewhere. So yes, we've had that sort of thing, but yeah, all sorts of other different innovative uses. So I think that just shows resilience, and that's probably all of these big department stores are going to end up being that so to drive traffic to the city centres. Some residential, maybe some office schemes, maybe experience-led things. That's what people want.
And I think for to sort of coming down the scale slightly, the interesting point about splitting up units into something neighbourhood you had there that was being wasn't massive anyway, but was being broken down into three, and you got lots of interest in those those three small potential units, which is which I think it just bears out what we think about where the market's sort of gone over this last 18 months, I suppose.
Yeah, definitely. I mean, it's not it's not cheap splitting something like that, but once it's done, and future proofing it does spread your risk of 3 tenants rather than one, and back to this whole they're probably going to be independents rather than nationals, and there's a lot to be said for that. After everything we've seen and everyone that's gone under during COVID and before, actually.
Yes, somebody who's very invested in it is going to, they're going to make it work if they very, absolutely put every bit of energy into it. Now I'll move on to Zach, if we may, and just talk about the industrial sector, but that also picks up on EPCs, which I think is been a hot topic for a long time, but becoming a hotter and hotter topic as we shed more and more light on it, really. Hi there, Zach. I think you didn't, well, I don't want to say you didn't tell us anything we didn't know, I suppose, in some ways, but that demand for industrial over these last few months, it's just been a great sector in terms of how it's been performing, hasn't it? And only held up by the lack of new stock, I suppose, but it was nice to hear about some of the pipeline stuff that's coming forward and schemes that are likely to be built, as we keep heading forward. But I think the interesting point around that, though, to my mind, is what's going to happen to other stock as new stuff comes along, particularly driven by the EPCs to a degree.
I think that's obviously the next hot topic, isn't it? Because demand is still very, very high for any type of industrial. It doesn't matter if it's second-hand or it's brand new. I mean, obviously, you're going to be able to achieve higher rate rents on the new stock, but we're seeing second-hand, 1980s and 1990s industrial, almost catching up with the new stock that's coming out for rents being achieved, which is amazing at the moment. But I think the really important thing that we've got to note here is that these older premises, with the EPC regulations coming in, they're really going to have to, or landlords are going to really have to start investing into their industrial premises they own and their portfolio, because over time, as we're seeing, it's only 10 years away that we're going to have to achieve a level B for an EPC.
Yeah.
So, and there's a lot of buildings out there that need that investment.
There was a couple of questions about EPCs in the chat here, and one from Brendan says MEs need to be at a certain standard, but only if financially viable, which in a lot of cases it isn't. And he also follows up with saying it's worth noting that do local authorities have the capacity to enforce in due course in any case, but taking the first point about the financially viable thing, that is a thing, isn't it? That is
definitely a
good point, and I think it's one that perhaps hasn't really been we haven't really seen that in practice very much yet, have we? Probably.
Well, no, we haven't, because obviously we've got to look at what type of occupiers are taking these premises. So at the end of the day, are you really going, Mr. Landlord, are you really going to not invest in your building if you're going to miss out on some pretty high quality occupiers for the future? And I think even if you do have a building, you're still going to want to be looking at improving and updating as you move on to keep up with latest trends and configurations of new developments.
So I guess there's a balance there, isn't there, between from our point of view as letting agents, if you like, between trying to avoid making investment that you perhaps don't actually by the book need to do, perhaps, but that might mean tenants may be different, and tenants might be voting with their feet, I suppose, going forward if they become more green aware as well, potentially, because that's the thing we haven't we haven't seen that many smaller tenants voting with their feet yet, have we? I think we're going to start seeing the corporate tenants of this world comparing a greener thing with a less green thing, and that being a big preference for the corporates, but we haven't seen so much of that with smaller occupiers yet. But
no, we haven't. But I would say that it's lack of supply right now. So anything that comes up, people are fighting over just to get into that spot. So it's something that is definitely going to be an issue in the future as these larger schemes get developed. I can talk about the small industrial sites such as Eurotech Park in Plymouth and Sky Park up in Exeter. Once they're all gone, they're gone, and it'll be the next phase and the next development that comes out, and then we'll have to make a decision from there where we are.
Yeah, and we've got another question here from somebody with some smaller industrial units that currently aren't requiring EPCs because of the lack of heating and other fixed air handling, I presume, and that sort of thing. So saying that they don't need EPCs when they're let. Do we see any change in future EPC requirements for the type of small industrial units? Well, I don't know whether we want to predict whether EPC regulations are going to change or not, but I suppose they have been set out quite clearly, haven't they, to how they are going to roll out over the next few years. But I think that small sort of non-EPC requiring sort of unit, if you want to think about that, is an interesting one, isn't it? Because that probably will still have a place in a sort of that position in the market potentially. And there is going to be a bit of a step change between where people perhaps who outgrow that, suddenly their costs may increase massively pro rata as they trade up to something which is, got an EPC and is much bigger and shinier sort of thing. That jump may be even bigger than they might expect it might be from an occupier's point of view, maybe.
Well, that's true. I mean, obviously, it doesn't necessarily mean that they're automatically exempt if there's no heating. If you've got offices and you've got WCs, etc., then if the building is capable of being heated, that's the way that it will be seen. However, I get the question that was, well, local authorities don't have the capacity at the moment. Yes, we are seeing that, but with everything that's coming in at the moment, we expect that to change.
Yeah.
How quickly is we don't know. No, but sure. I would say again, with small industrial, we're talking about getting the best occupier, because at the moment those headline rents are extremely high. And actually, if you've got a premises where, and you've got to look at things I mentioned it earlier about people not necessarily needing retail space. Because actually they don't need a shop window and they're selling all online. Therefore, they're going to have office requirements. They're going to have numbers of staff, and it's really how they're using the premises at the moment. They're light industrial business units as opposed to your general industrial, workshop space. So I still think EPCs, you need to look at that, even if you deem the building exempt.
Yeah, and you're right. And that's another interesting point we haven't got time for right this minute. It's just that you can see the effect on rents by that as well, can't you? That we're getting to a point where rentals at a certain level are becoming very similar, whether it's industrial, office, or probably even a kind of vaguely similar tertiary retail unit sort of thing.
Exactly.
So people are picking and choosing between all those. Yeah, right. Okay, thanks for that. We'd better move on a little bit. There's another question here about, I understand that very few build to rent schemes in Cornwall, the southwest. Do we think that will change? I'm not sure exactly what a build to rent scheme is in a way, but in terms of somebody speculatively building an estate or a handful of premises, unless we're talking about the residential sector, of course, I'm not sure. So I'm not sure how to answer that one. I think in terms of if it's commercial we're talking about, then the amount of speculative development going on is not extreme because of the difficulties of finding sites to build and the pressure of costs and that sort of thing. But if we're talking the private rented sector for housing, maybe that's something I could drag Tim in on. Is that you there, Tim?
I'm sorry.
It's all right, you're nearly with us.
Yeah, sorry, I was trying to go online.
Yeah, the rental sector. Yeah, rental sector. Yeah, is that?
Well, the build to rent sector, and that is quite a specific type of product, which has worked very successfully initially in London and the higher value urban areas. The issue with the build to rent sector is very much based on offering a different product to renters, which often includes a lot of added extra management costs, a lot of extra communal space, communal areas. And this is one thing that's kind of suffered in this pandemic. A lot of people who are in, when you're designing a build to rent scheme, often the the individual per unit external space is compromised to provide more communal space for everyone. And in the pandemic, that didn't really work out too well, but it is still a very strong model. In the southwest, it has struggled. Values are catching up, but the value to cost ratio hasn't quite worked for a lot of places. I have looked at a couple of things in Plymouth, and that is one area I think they're pushing it. Obviously, Bristol's done quite well, and I think Exeter will as well. But I think that has been the issue, just that cost-value relationship.
Okay, thank you. I wasn't really tuned into that as being where the question was coming from, but I'm really pleased I could pull you in on that and get I wasn't tuned into thinking residential to begin with, so apologies for that all round. Whilst you're here, Tim, in terms of poll results and any other thoughts about the development market, I was just scanning through there. I mean, everybody recognises costs. I think that is a big point anyway. The rising cost both in commercial and residential development, and perhaps you can give us some thoughts on that in a sec. But and where that's likely to go, great crystal ball sort of thing. But there's also some concern here. 26% of supply of new sites coming forward. I suppose we're still in a case. There is some case anyway. There is a lot of sites out there that just are stalled for one reason or other.
This is
I suppose.
I think the stuff that what I've seen over the last 12 months is everything that was ready to go and had progressed to a certain level has gone through, and I think we've seen that with the housing delivery numbers that I mentioned. There obviously has been a lot of stalling in terms of people being out there meeting, doing deals, and I think we are going to just see that lag in the pipeline. The planning system, as I've already mentioned, it was under pressure before. It's taken a long time to register applications and get them through. That hasn't been helped by the fact that they're continually understaffed and have had to do some quite challenging working practices, and I do feel for them on that side of things. Overall, that is giving us that pinch, which is doing a lot for the land market in terms of the value of land going forward. But again, that will have an impact down the line as we're seeing this lag of rising construction costs. People are now paying for strong money for sites now. Down the line, is that going to be financially viable? And what does that mean for the provision of affordable housing and 106 obligations, which I know can be viewed in different ways depending on which side of the coin you are, but it is a big, it's an important part of how we deliver places and spaces.
Probably too big a question for now, or maybe there's a simple answer, I don't know. But is the land price in the middle of this going to get pinched by every, or is the finished product prices currently, enabling the land price not to be pinched?
I think that there has been a period since the housing crisis and viability was brought into the planning process. There has been a slow increase in the value of land beyond probably what the market is actually pushing it towards. I think that the issues with viability and the tightening up of the viability regulations, which give local authorities more strength and power to protect their case, has resulted in a slight rebalancing of what people actually think they can pay for. If it's too strong, they won't actually be able to deliver, and it might be more hassle than it's worth. So I think we might see a resteadying of values, but I think that values are robust. The housing market, as I'm always going on about, is underpinning things for the moment, and I think the numbers that I've seen, it seems as though the next 6-12 months are looking strong, and we will continue to see price rises, hopefully. Especially in the southwest. And it's done wonders for this region, so it's great.
Okay, thanks very much, Tim. Thank you. There was an investment-related question here somewhere I saw, and that's one for Claire to jump back on stage if she's around. About I know we do work for Cornwall Council. We've seen many of the councils around the region taking different view on purchasing with investments. Claire, so we've got a question from Ian here asking about the council's various attitudes to purchasing of investments. I mean, they were very keen buyers of investments pre-pandemic, I suppose. Did you pick up on that slightly in your talk, or almost not quite?
Yeah, and we have seen that change over the last 6 months. A lot of feedback we're getting is that they're due to regulation changes in funding as well and administration changes. It's now very much looking within their patches rather before it was all over the region, and it's to do with more regeneration and something that would otherwise not be delivered by the market. as opposed to conventional competing with your everyday commercial investors like we've seen. So yeah, quite a big change there.
And from your point of view on the investment front, you did touch on this anyway, but I think you did, EPCs again and the whole energy performance thing, and this sort of, I'm not sure, well, is it a two-tier market we're heading for? Have we got it already? I don't know. But, the energy performance and the greenness of properties is going to be a bigger and bigger decision-making factor, isn't it, for investors? And investors are going to have different attitudes to them, depending on where they come from, sort of thing.
Yeah, they are. And also in investment terms, 7 to 9 years away isn't very long, because a lot of their current tenants could well be the ones in occupation when this becomes reality. So, all the leases that have been agreed, it's just thinking about that now and being prepared. And I think it will, depending on the cost and the type of building, then it could impact on value.
Yeah. Yeah, I know a lot of the funds are looking to be much, much greener, aren't they? So, at the middle and upper end of the investment market, I'm sure it's going to become it's a really hot topic. Thanks very much, Claire. I'd like to get Mike in briefly just to follow up on his comments about the leisure sector. Mike, are you around? There he is. Hi, Mike. I was just looking for your poll results here. We've got 46% thinking of going abroad next time round, and still 50-odd% Southwest or UK. I suppose that's as expected, really. And people are going to, a lot of people are still going to holiday UK next year because of the certainties that it's got, and they didn't quite make it this year, or perhaps had a good experience this year and want to follow it up again next year.
I think it's probably more indicative that people are more confident that they can get abroad next year.
Really.
I think that's almost probably a couple of years ago, you would have seen that stat for, if you like, domestic tourism at probably 45%, and anywhere in Europe and beyond at 55%. So I think it's just a slight swing. But I think ultimately it shows confidence. I think we're also asking the audience that are already in the Southwest if they're going to holiday in the Southwest. It'd be interesting more probably to ask that in Birmingham or London. We've got to accept we see so many people that wash into our region from out of area. But yeah, I think ultimately it just shows you that people are probably more confident that they can go abroad next year. I think we've had a very good time of it this year in terms of numbers, but it's brought about all the challenges as I did in my piece, really.
Yeah. It was interesting. You said that stock levels are beginning to open up a little bit in terms of leisure property to sell, as people have, endured in a kind of a good way in terms of revenue probably, but endured this last season. They've got this far, and so plans they had to sell up or not or whatever, they're now talking to you about cashing in, as you put it. But I guess it's also going to be another hardcore of people who are thinking there's another strong year ahead potentially, that they're going to tough it out for another year. Yeah,
I think very much that's the case. I think potentially there's a tipping point next year, probably at the back end, probably a year from now, where I think there'll be those that'll say, yeah, we'll go one more year, make the best we can. Everyone's been trying to recoup. A lot of people had the benefit of the support, and then they knew that they'd be busy. So it's sort of head down, here we go.
Yeah.
But, there's a fair percentage of operators that were quite tired, really, just coming into this season with just how different their day-to-day lives are, and what they're coping with. And there's a few now that are just saying, yeah, enough's enough. We've had a good year. There's not a lot around. I think pricing's quite good, pretty stable. So there's better chance for an exit. And whether or not that changes, in a year, 18 months time, where we might just see a bit more stock, a bit more where people need to get out rather than want to get out.
Yeah.
We'll have to wait and see.
Yeah. Okay, Mike. Thank you. Thanks very much for that. I'm conscious we're now sort of into borrowed time now. We're over an hour, and people are starting to drop away a little bit in terms of our numbers. So I will just try to wrap things up a little bit in the next few minutes. There were a couple more questions which I wouldn't mind just having an opportunity of answering here. How important do we view the impact and legacy of ERDF on the commercial property market in the Southwest? Obviously, European funding. Well, it's been key, hasn't it? So it's made the delivery of a lot of very good product that's ultimately let very well happen. So and that sort of links with a later question here. Do we see rents increasing sufficiently to make it viable for developers to supply the market, or are we still reliant on grant support? If the latter doesn't materialise, then what will the economic impact for Cornwall be? Crikey, quite a lot to answer probably when I'm on borrowed time anyway. But we are seeing rents increase, and that's part of some of perhaps Zach's talk on industrial in particular. But it is very difficult to predict what's going to happen. We are seeing some people talking Cornwall now who are developing, probably those who bought land or have been sat on land. So land is in their sort of calculations at a cheaper rate than somebody going out to purchase land afresh at the moment. Is probably sitting in a better position because they don't have the same amount of money invested in the simple part of it, the land itself. So we're just going to have to see. But from our point of view, from an agency point of view, we're very conscious of looking at rents all the time, because if we haven't got the rents or the end prices, then that's just going to make the supply of new stock even more difficult. So people are going to have to continue to be used to paying increasing rents in our view. And then there's another question here about EPCs. Somebody needing some advice on how to actually achieve a band B, and have we got any thoughts, and maybe better to demolish. And I think that's the question going forward over the next period, whatever we want to call it, whether it's right now or over the next few years, is we may get to a stage where, well, firstly, I think our building surveyors are going to be busier than ever in actually engaging with people and advising on the EPC and MEES factors, which we've had some involvement in, but landlords haven't really wanted to invest in the advice quite as much as they're perhaps going to need to. And out of that, we're going to see whether some of the older stock, which probably is becoming less energy efficient by modern standards, may reach a point where no longer can it sort of soldier on, and redevelopment might be the only potential thing to be done with it. We'll see. Anyway, I'm really conscious that we're a bit over our hour now. I'm very grateful for everybody hanging on and attending, and grateful for the poll results and the questions that have been chipped in as well. Mark at the start did say about a couple of other events we've got coming up online, which I've lost my bit of paper here now, which has the dates on them, but they're yes. So we've got a hospitality webinar on November the 16th, and a quarterly development sector catch up on December the 1st. So you can register for those going to the events page on the Vickery Holman website. Thanks very much to all our contributors today, and thanks again for everybody for attending. Thanks for everybody behind the scenes who helped us organise this, and look forward to seeing you all again very soon. Thanks very much indeed.